Hey everybody, it's Coach Chris here. It's Wednesday morning, and today is part three of our 10-part series. And we're picking up just very briefly, sort of where we left off yesterday on part two, Tuesday's episode. And where we left off, we were talking about how if you stick to the bank's plan, also called the amortization schedule, then it is a long, slow road to nowhere, as is illustrated on this chart on your screen. On this quote 4% amortization schedule, you can see that 15 years into it, you're still paying 46% of your minimum payment to interest. So the way to fix that is to do interest cancellation. So in the example that we looked at previously with the 6% interest rate, if we sent in 11.99 and 10 cents, 199 and 10 went to principal and the rest went to interest. Now, as we talked about in the last video, this quote 6% loan, that's 83% going to interest in the first month. However, the point of today's video is not to review that, but to point out that in this example, I'm pointing at the $200.10, which is the amount that would go to principal if we only made the minimum payment the next month. However, in this particular amortization schedule, if we sent in $200.10 at the same time we sent in the minimum payment back here, then that would cancel $999 of interest. In fact, if we took that logic one step further and we sent in, as you can see here at the bottom, the $1,010.54. Now, by the way, we could send in any amount. These are just examples. But on this AM schedule, if we sent in 10, 10, and 54, it would knock out each of these payments, sort of like the game Whack-A-Mole. If you've ever been to Chuck E. Cheese or someplace like that and seen the game Whack-A-Mole, we are pounding down these payments and they are gone. We do not have to make these payments. They are eliminated from the back end of the amortization schedule. So sending in 1,000 obviously is going to get us out of debt faster because, hello, we sent in an extra $1,000. But it's not just the $1,000, it's also almost $5,000 of interest cancellation. Now, one other example of this, say we were able to send in as much as 5,000. And I don't really know anybody who could send this in every month. We probably had to save up for this for a while. But by the same logic we were just talking about, by sending in an extra 5,000, we eliminate, like the Whack-A-Mole thing, 23 payments. That means if we started with a standard 30-year loan, we now only have 337 payments instead of 360. If you go back and check out my very first video in this series, I told you the story about my personal mortgage and being able to get out of debt 10 years sooner. Gang, this is why. So it's not just the getting out of debt faster, it's also saving money. So in the example we're looking at here, by sending in that $5,000 extra, we're eliminating $23,000 in interest that we would have paid. That's why in my personal situation, I could save $109,000 with a couple $100 of discretionary income. So moving forward here on the closed-end loans, to briefly summarize, we can't really avoid them. The takeaway is not to never get a car loan or student loan or mortgage, but the takeaway is to get them paid off as fast as possible so that you can reverse the bank's profitability back to you. And who wouldn't want to do that? So our next topic here as we roll into this is using open-end credit lines, such as a credit card or a line of credit, whether it's a business line of credit or any other type of line of credit like a HELOC. There's a fundamental difference compared to the closed-end loans we've been talking about. The biggest one is you can put money in and you can take money out. It's not like the black hole in space. And so with open-end credit lines such as credit cards, we're able to use float and leverage, which means we get to use other people's money, not just other people, the bank's money. And we can use the bank's money interest-free if we pay off our balance by the end of the month, which about half of American households do. So to briefly review some of the terms and conditions of a credit card, let's roll forward here for a second. We're going to come back tomorrow and talk about this banking info, but I'm going to come forward here and we're going to look at some terms and conditions of different types of loans. So when we're talking about a credit card, let's go back and just look at credit cards here. If we have credit cards, about half of American households do keep a balance on their cards, 46% according to Google. And what that means is that those households are not taking advantage of float and leverage. Because what we want to do is we want to get the credit card utilization down to zero. Then we want to use the credit cards, pay as many bills as we can with them to free up our cash flow, because we can use our cash flow for interest cancellation, like we were just talking about. Then we can pay off the cards at the end of the month so that we don't incur any financing charges. Now, let's just take one little step back. According to the research I did this morning, as I already mentioned, about half of the households in America do keep a balance on their cards. So those households need to, first of all, get that utilization down to 30%, because by getting it down to 30% or lower, that's going to improve our credit score. And that's a side effect. That's not the main reason we're here, but there's nothing wrong with improving our credit. So if we're using credit cards the right way, they're going to help us get out of debt faster by freeing up our cash flow to do other things like interest cancellation. And the things such as closed-end loans, like a student loan or a car loan or a mortgage, we can pay those off faster by having better discretionary income. Now, tomorrow, come back. The next part we're going to be looking at is how you can actually be your own bank. And here's a little quick preview. Banks do not like to borrow money from each other because they have worse terms and conditions than they can get with their preferred loan vehicles that are available in an open-ended line of credit through a cash value life insurance policy. I know that sounds kind of weird, doesn't it? But come back tomorrow and we're going to talk more about that. What I want to talk about for the last thing today is simply this. If we have terms and conditions on a loan, what we're used to for a loan is if we apply, depending on our credit rating, we could be approved or we could be declined. Some people could be declined. If we didn't make the payments on time, we would get in trouble with our credit score. In fact, if we missed payments for such a long time that the creditor wrote that loan off and it became called in, when they write it off, it becomes a taxable event. And that's disastrous for families because on top of having that credit crunch, there's also a taxable event and they now owe taxes on that income. So that's something we want to avoid at all costs. And that's why the banks don't like those kind of terms and conditions. Now, if there was something that was completely the opposite of that, and by the way, there is, so come back tomorrow and we'll learn about a much better way to get a loan. In fact, it's the way that banks like to get their money, and it's called bank-owned life insurance. So come on back tomorrow for part 4, and we're going to really roll up our sleeves and dig into what it means to be your own bank. So this is Coach Chris signing off for now, and looking forward to seeing everybody tomorrow. And you have a great Wednesday. Take care, everybody. Bye for now.